The discussion begins with a shift in focus away from the commonly quoted market price of silver and toward a different measure entirely. Instead of asking what silver trades for in dollars at any given moment, attention turns to the relationship between the supply of dollars and the supply of silver itself. This perspective reframes the conversation. It moves the emphasis from short-term price movements to a broader comparison between a physical metal and a monetary system that can expand over time. Within this framework, the value that draws attention is not a market quote but a calculated figure that reflects a changing balance. It represents a relationship rather than a transaction price. The number appears striking because it is large, yet its meaning lies not in what silver currently costs but in what the ratio suggests about the relative growth of money compared with the production of metal. By presenting this ratio, the analysis encourages viewers to consider how value can be interpreted when measured against the expansion of currency rather than against daily market fluctuations. The central idea is that price alone does not capture the full picture. Market prices move up and down, responding to short-term demand, sentiment, and trading activity. A ratio, however, attempts to measure a deeper relationship. It compares the pace at which dollars are created with the pace at which silver is produced. This comparison highlights a structural contrast between a system capable of rapid expansion and a resource that must be mined from the ground. Looking at the relationship in this way changes the frame of reference. It suggests that understanding silver requires more than watching its chart in isolation. Instead, it calls for examining the broader monetary environment in which that price exists. The number that emerges from this comparison becomes a reference point. It is presented as a way to evaluate the scale of monetary growth relative to the production of a finite physical resource. This approach sets the tone for the analysis that follows. Rather than focusing solely on fluctuations in the silver market, it invites consideration of how the expansion of money interacts with the limited supply of metal. By doing so, it establishes the foundation for examining how the relationship between currency and tangible resources can evolve over time and how that evolution shapes perceptions of value. At the center of this analysis stands a figure that commands attention: $1,198 per ounce. It is presented not as a trading price and not as a forecast of where the market must go, but as a ratio derived from a specific comparison. The number emerges from dividing the year-over-year increase in the United States M2 money supply by the total amount of silver produced globally in 1 year, measured in ounces. In that calculation, the expansion of currency is set directly against the output of a physical metal. This figure is meant to illustrate scale rather than predict timing. By placing the growth of money alongside the quantity of newly mined silver, the ratio highlights how quickly one side of the equation can change compared with the other. The supply of dollars can increase through digital creation and monetary expansion. The supply of silver, by contrast, depends on mining, refining, and physical production. The number that results from this comparison reflects the difference in those rates of change. The emphasis on a ratio rather than a market price shifts the conversation toward relative value. If the quantity of dollars grows more rapidly than the quantity of silver, the relationship between them changes even if the market price does not immediately reflect that shift. The figure serves as a representation of that imbalance. It does not claim that silver must trade at that level in the market. Instead, it expresses how much monetary expansion corresponds to each ounce of new silver produced within a given year. Understanding the calculation requires focusing on its components. On one side lies the increase in the money supply over a defined period. On the other lies the annual global production of silver. When the growth of money is divided by the quantity of metal produced, the resulting number becomes a measure of how many newly created dollars correspond to each new ounce of silver entering the system. This comparison is presented as a way to visualize the relationship between monetary expansion and physical output. The significance of the number lies in what it represents rather than what it predicts. It underscores the difference between a currency system that can expand rapidly and a metal whose production follows a slower, more constrained process. By highlighting this ratio, the analysis invites consideration of how these two forces interact and how their differing rates of change influence perceptions of value over time. A key contrast emerges when examining how dollars and silver come into existence. Modern currency systems allow for the rapid creation of new dollars through digital processes. Most dollars today are not printed as physical notes but exist electronically, expanding through financial mechanisms and policy decisions. This capacity for digital creation enables the supply of currency to grow at a pace that can change significantly within short periods. Silver follows a different path. It cannot be created through keystrokes or digital entries. Each ounce must be extracted from the earth, processed, and refined before it becomes part of the available supply. The process requires time, labor, equipment, and geological discovery. Production is tied to physical realities that cannot be accelerated beyond certain limits. This distinction establishes a fundamental difference between the two. One can expand rapidly in response to policy or financial conditions, while the other increases gradually through physical production. The inability to produce silver at will forms a central part of the comparison. When the supply of dollars grows quickly, the relative relationship between currency and metal changes. Each additional unit of currency represents a claim within the system, but it does not automatically correspond to an increase in physical resources. Silver, constrained by mining and production cycles, does not respond instantly to changes in monetary expansion. The pace of its supply remains comparatively steady. This contrast between digital creation and physical extraction shapes how the ratio between dollars and silver evolves. When money expands at a faster rate than metal production, the balance between the two shifts. The ratio discussed earlier captures this divergence. It reflects not only the amount of currency created, but also the limitations on increasing the supply of a tangible resource. The inability to print silver becomes a defining factor in understanding the relationship. By placing these two systems side by side, the analysis emphasizes their differing characteristics. Currency can be expanded through financial mechanisms, while silver remains tied to physical production. The distinction does not rely on speculation, but on the observable difference in how each is produced. This difference underlies the calculation of the ratio and helps explain why the comparison between money supply growth and silver output is considered meaningful within this framework. The broader fiscal environment provides additional context for this comparison. The national debt has reached a level measured in tens of trillions of dollars, reflecting the accumulation of government borrowing over time. This rising total continues to expand despite the presence of revenue sources such as tariffs and taxation. The scale of the debt becomes a backdrop against which monetary expansion and resource production are evaluated. It reflects the ongoing growth of financial obligations within the system. Revenue streams can influence the pace at which debt grows, yet they do not eliminate it. Even when new income enters the system through tariffs or other channels, the total obligations remain substantial. There is also uncertainty surrounding how long certain revenue sources will remain in place, as legal and institutional processes can alter or reverse them. This uncertainty introduces another variable into the financial landscape. It suggests that future revenues may not always align with current expectations. The presence of a large and growing national debt contributes to the broader discussion about monetary expansion. Borrowing on such a scale often intersects with the growth of the money supply. As obligations increase, the mechanisms used to manage them can influence how much currency circulates within the economy. This relationship between debt and money supply forms part of the environment in which the ratio between dollars and silver is considered. By placing the national debt alongside the expanding money supply and the limited production of silver, the analysis highlights a system characterized by growth on multiple fronts. Financial obligations rise, currency supply increases, and physical metal production follows a slower trajectory. The combination of these factors shapes the context in which the ratio is examined. It underscores the difference between expanding financial measures and constrained physical resources. The discussion of debt does not serve as a prediction but as an observation of scale. The total amount of outstanding obligations represents a significant figure within the system. Its continued growth, coupled with the potential variability of revenue sources, contributes to the broader monetary environment within that environment. Comparisons between currency expansion and metal production take on additional relevance, forming part of a larger examination of how financial systems and physical resources interact over time. Another layer of analysis focuses on the expansion of the M2 money supply. This measure represents a broad category of money circulating within the economy, including cash, checking deposits, and easily convertible near-money assets. Over recent years, this supply has increased significantly, reaching some of the highest recorded levels in the observed timeline. The growth reflects a substantial expansion in the amount of money available within the financial system. Between 2023 and 2024, the increase in M2 stands out as particularly notable. The upward movement on the chart signals that more currency has been introduced into circulation over a relatively short period. This expansion is not merely incremental. It represents a pronounced rise compared with earlier points in the same historical record. As the quantity of money grows, the relationship between that money and tangible goods or resources shifts accordingly. The connection between an expanding money supply and inflation forms part of this discussion. Inflation is described here as a hidden tax, a process that reduces purchasing power without appearing as a direct deduction. When more currency circulates in the system, each unit may represent a smaller share of value relative to available goods and resources. Over time, this can affect the perceived strength of the currency and the cost of acquiring physical assets. The increase in M2 therefore becomes relevant when comparing dollars to silver. If the supply of currency expands rapidly while the supply of silver grows more slowly, the ratio between them adjusts. The calculation that produces the previously mentioned figure reflects this dynamic. It incorporates the growth of money as a central factor in understanding the relationship between currency and metal. As the money supply reaches higher levels, the comparison becomes more pronounced. By examining the rise in M2 alongside the steady pace of silver production, the analysis highlights the contrast between a system capable of rapid monetary expansion and a resource constrained by physical extraction. The growth in money supply serves as a key component in the ratio being discussed. It illustrates how changes in currency circulation can influence the broader relationship between financial measures and tangible commodities, shaping perceptions of value within the system. A longer historical perspective deepens the comparison by looking back more than a century. In 1913, the ratio between the amount of money being created and the production of silver stood at approximately $2.66 per ounce. This figure serves as a reference point for understanding how the relationship has changed over time. By comparing that earlier number with the much larger figure discussed in the present context, the shift in scale becomes apparent. The difference between the earlier ratio and the current calculation reflects a long-term transformation in the monetary environment. Over decades, the supply of currency has expanded through various mechanisms, while the production of silver has followed a more gradual path. The comparison between the two time periods highlights how the relative balance between currency and metal has evolved. The earlier figure represents a moment when the relationship between monetary growth and physical production was far narrower. This historical contrast is presented not as a prediction but as an illustration of change. It shows how the value of currency relative to silver can shift when the supply of money grows at a faster rate than the supply of a tangible resource. The widening gap between the earlier ratio and the current one underscores the cumulative effect of monetary expansion over time. Each increase in the money supply adds to the difference, gradually altering the proportion between dollars and ounces of silver. Looking back to 1913 provides a baseline from which to measure this transformation. The smaller ratio suggests a period when the amount of newly created currency corresponded more closely to the quantity of silver being produced. As the years progressed and monetary expansion accelerated, that balance changed. The comparison between past and present figures highlights the extent to which the relationship has shifted. By placing the historical number alongside the current calculation, the analysis frames the discussion in terms of long-term change rather than short-term price movements. The contrast emphasizes how the relative value between currency and metal can evolve across decades. It serves as a reminder that the ratio being discussed is part of a broader timeline in which monetary expansion and physical production have moved at different speeds, gradually reshaping their relationship. Attention then turns to the role of physical silver as a form of holding value within this environment. The discussion frames physical ownership as a way to stand outside the mechanisms that expand the money supply. When currency can be created digitally and in large quantities, holding a tangible asset introduces a different kind of relationship to the system. Physical silver exists independently of the processes that increase the number of dollars in circulation. The emphasis on physical possession reflects a concern about how monetary expansion and government spending can affect the value of currency over time. If the supply of money grows while the supply of silver remains limited by production constraints, the relative position of each changes. Holding a physical asset becomes a way to maintain exposure to something that cannot be created through policy decisions or financial instruments. It represents a direct form of ownership rather than a claim within the financial system. This perspective highlights the contrast between tangible and intangible forms of value. Currency balances, digital accounts, and financial instruments can expand as the money supply grows. Physical silver, by contrast, must be mined and refined before it becomes available. The difference in how each is produced shapes the reasoning behind holding metal directly. It is presented as a method of maintaining a connection to a resource that is not subject to the same mechanisms of expansion as currency. The discussion also points to government spending as a factor influencing the broader monetary environment. As spending increases, it can intersect with borrowing and the growth of the money supply. In such a context, holding a physical asset is framed as a way to maintain distance from those processes. It does not eliminate exposure to economic conditions, but it changes the form in which value is held. The emphasis remains on the distinction between a system that can expand and a resource that remains physically constrained. By focusing on physical silver, the analysis underscores the idea of ownership outside the expanding monetary framework. It suggests that holding a tangible metal provides a different relationship to value than holding currency alone. The reasoning rests on the contrast between the ability to create dollars digitally and the inability to produce silver in the same manner. This difference forms the basis for viewing physical silver as a way to engage with a resource that remains limited by its method of production. Another factor shaping this perspective is the condition of the silver market itself. The discussion points to a structural deficit that has persisted for several years. In this context, a structural deficit means that demand for silver has exceeded the amount of new supply entering the market when consumption and investment requirements outpace production. The imbalance becomes a recurring feature rather than a temporary fluctuation. This situation is described as having continued into a sixth consecutive year. A sustained gap between demand and supply places pressure on available inventories. When more silver is required than is produced annually, existing reserves must fill the difference. Over time, that process can reduce the amount of readily accessible metal. The continuation of this deficit over multiple years suggests that the imbalance is not isolated to a single period but reflects ongoing conditions within the market. Each year in which demand remains higher than supply adds to the cumulative effect.